Forex runs 24 hours a day, but only 4 actually matter. Here's the window that does.
The Forex market is open 24 hours a day, 5 days a week. But for a retail trader, only about 4 of those hours actually matter. Trade the wrong window and you'll pay for it in ways your platform doesn't show on the cost summary. Let me explain. The market doesn't run as one continuous block. It runs in 4 overlapping sessions: Sydney, Tokyo, London, and New York. And each one has a completely different personality. Volume, volatility, which pairs move, how wide your spread is, all of it changes by the hour. Here's what most beginners get wrong. They assume the market is the same all day. It isn't. The difference between trading at 9 a.m. London and 9 p.m. London can be the difference between a clean breakout and a 5-pip stop out from spread alone. That gap between the hour you actually trade and the hour you should trade is what we're going to fix. Let's walk the sessions. Sydney opens first, 2100 UTC. It's the quietest of the 4. Lowest volume, lowest volatility, and unless there's an RBA rate decision, almost nothing moves. The Aussie and Kiwi pairs do trade, Aussie JPY, New Zealand JPY. But if you try to scalp Euro-US dollar during Sydney, the spread will eat you alive. Why? Because the major banks running tight quotes on euros aren't at their desks yet. Thin book, wide spread. Simple as that. Tokyo opens at midnight UTC. Volume picks up. This session has a real personality. Technical levels actually hold here, which makes it decent for breakout trading on JPY pairs. USD JPY, Euro JPY, GBP JPY all move. One thing to flag: Japanese data drops around 5 to 600 UTC, and JPY pairs spike sharply on those releases. Don't sit through that window with a tight stop unprotected. London opens at 700 UTC, and this is where everything changes. London is the highest single session volatility of the 4. Volume floods in. Euro and GBP pairs come alive. And from 8 to 10 UTC, you get a cascade of European data. PMIs, GDP prints, ECB statements that create the cleanest directional moves of the day on the majors. If you trade Euro US dollar or GBP US dollar, London is your home session. Full stop. Then New York opens at 12 UTC, and for the first 4 hours, London and New York are both running. This is the overlap. Highest volume of the entire 24-hour cycle. Tightest spreads, cleanest setups. US data lands between 1230 and 1400 UTC. NFP, CPI, retail sales, and those releases move every USD pair, plus gold and oil, sometimes hundreds of pips in minutes. After 1600 UTC, London goes home. The book thins. By 2000 UTC, liquidity drops so hard that entering a new position in that last hour is essentially asking to be slipped. Avoid it. So if you map liquidity across the day, there's only one window that consistently has tight spreads, high volume, and clean directional moves: the London-New York overlap. 12 to 1600 UTC. 4 hours. That's it. Everything outside that window is a trade-off. You can still trade, but you're paying more for worse setups. Now the economic calendar. Forget vague, high-impact news warnings. There are 2 events every month that move the market more than anything else. NFP, non-farm payrolls, first Friday at 1230 UTC, and FOMC decisions, roughly every 6 weeks at 1800 UTC. Around these releases, spreads on majors widen 3 to 10 times normal for 1 to 5 minutes. A pair that normally sits at 0.8 pips can blow out to 8 pips in a heartbeat. If you have a tight stop and the spread spikes through it, you're out. Even if the market never actually traded at your level. That's the mechanism most beginners get burned by. Not the news direction, the spread spike. The fix is simple. Don't hold tight stops through NFP or FOMC. Either close positions, widen stops well beyond the expected spike, or just don't be in the market during those windows unless you're specifically trading the news. Weekend gap risk. The Forex market closes Friday 2200 UTC and reopens Sunday 2100 UTC. 23 hours where you can't trade, but the world keeps moving. Central banks issue emergency statements, geopolitical events break, Chinese data drops Sunday morning. When the market reopens, it gaps, meaning Sunday's first price is wherever accumulated news says it should be, not where Friday's close was. Typical gaps: 5 to 20 pips on majors during quiet weeks. Event-heavy weekends, 50 to 200 pips, sometimes more. Here's the part most retail traders don't know. Your stop loss does not protect against gap risk. The order fills at the next available price after the gap, not at your stop level. So if you held long Euro US dollar over a weekend and Monday opened 80 pips lower, your stop fires at -80, not at -20. The only thing that actually protects against gaps is a guaranteed stop loss order, a GSLO, and most US brokers don't even offer those. If you hold positions through weekends, assume a 0.5 to 1% adverse move on major pairs, and size your position so you can survive it. Best hours for you by where you live. If you're in Europe, 9 a.m. to 1 p.m. local. That's the London session plus the start of the New York overlap. Cleanest window of your day. US East Coast, 8 a.m. to noon local. Same overlap, just from the other side. Asia, your best window is actually 3 to 7 p.m. local time, late London. Still highly liquid, and it fits home evening hours instead of forcing you to trade at 3 a.m. One last technical thing, daylight saving. London and New York shift by an hour twice a year. Sydney and Tokyo don't. So during the 2 to 3 weeks in late March and early November, when one side is shifted and the other hasn't, the entire overlap moves by an hour. Check your platform's session indicator during those weeks. Don't assume yesterday's window is today's window. So here's the verdict. The Forex market is open 120 hours a week, but the window that actually matters for retail traders is the London-New York overlap. 4 hours a day, 12 to 1600 UTC. Spreads are tightest, volume is highest, setups are cleanest. Outside that window, you're either trading the right pair for the right session, Aussie during Sydney, Yen during Tokyo, Sterling during London, or you're paying for the privilege of being in a market that's against you. And the two events to actually mark on your calendar are NFP and FOMC, because that's where the spread spike will eat your stop before the price ever gets there. Trade the overlap, respect the calendar. Never hold a tight stop through the weekend. Do that and the hours stop costing you money you couldn't see.
Trade the London-New York overlap, mark, NFP, and FOMC, respect the weekend. Full breakdown linked in the description.